this along with me, my colleague and fund manager, Amit Premchandani. He manages the UTI Value Opportunities Fund, the UTI Dividend Yield Fund, and also the UTI Regular Savings Fund. So we are going to be conducting today's session much like we do every month, which is to say that we'll start with a presentation where I'll talk about some of the key insights that we wanted to share with you, and as well as some of the macro data. And then after that, Amit will talk about the strategy that he's managing in more detail. And then finally, we'll move on to the question and answer session. I believe we've already received quite a few questions. So some of them, my colleague Niranjan, who has put together the presentation, and he'll also be pulling up the presentation on the screen shortly. He will handle the Q&A. And do keep your questions coming in because time permitting, we'd love to be able to cover some more of the questions that we are receiving on a live basis from you. So without any further ado, let's get rolling with the 10th edition of the Equity Market Insight for 2023. Right. So what are we going to talk about over here? Now, I know that most conversations with investors when we talk about the Indian equity market is about the decoupling of the equity market with the US markets. What I'm talking about here is the decoupling which has happened of the bond market, particularly in terms of the market rates between the US and India. So I know there's a bit of a busy slide, but just look carefully at the data which is shown there, and you can see over there the policy rate which is shown in the bars. And you can see that India started hiking rates sometime in early 2022. The policy rate has gone from 4% to 6.5%. In the US, they have, of course, been at the zero bound for rates for a very long time. They also started their journey of liftoff from 0.25 in early 22, and they have moved all the way up to 5.5%. So almost a 5.25% increase in their repo rate, whereas in India, the rate has moved up only by about 250 basis points. Though if you look at the actual policy impact, I would actually argue that it's closer to about 340, 350 basis points of rate action. But what's more interesting are the two lines that you see on the chart, the wavy lines. The blue one is the 10-year India GSEC, and the golden line is the 10-year GSEC of the US. So at the point where the policy rate was 0.25, the 10-year yield of the US was at 1.83, and then in recent days it has spiked up close to 5%, though at the month end it was at 4.57. So almost a 300 basis point increase in the 10-year bond yield. But during that same time, if you look at the India 10-year bond yield, what you can see here is that it's more or less been flat. It was at 7.14 when the policy rate was at 4%. And today, the bond yield is at 7.22. In fact, sorry, as of today, it's closer to 7.32. So it's gone up by just about 20 basis points, when the rate action has actually been about 250 basis points of policy rate action. So in a sense, there is some decoupling which has happened here. The policy rates have not transmitted fully, neither has the 10-year bond rate. Now, this shouldn't be a surprise in some senses because the macroeconomic situation for these two countries is currently very different, and the post-pandemic era has played out differently for both economies. So this is an outcome of that. But at the same time, it's surprising because in the past we've been used to rates tracking each other a lot more closely than what we have seen this time around. So decoupling is now something that we are seeing in the bond market as well as in the equity market. So let's move on from this to look at the next slide. And what I wanted to do here is just highlight how some of the global markets have done. And in the case of India, we have broken up India's performance into not just the Nifty 50, but you've got the India mid cap, the India small cap, the India large cap. So Nifty 50, Nifty mid cap, Nifty small cap. And then what we've also done is we have picked up the return in the US large cap, US small cap, and we have also picked up the return of the US technology index, which is the NASDAQ. So these are the 2-year returns. These are the point-to-point 2-year returns from September of 2021 to September of 2023. And what you can see here is that India mid cap and small cap is pretty much top of the charts over here. In fact, India large cap from a US denominated investor's point of view. So the numbers that you're seeing here, we have actually adjusted them because this is what global investors see. India's Nifty 50 is more or less unchanged over a 2-year period, very similar to the S&P 500, which is also unchanged over a 2-year period. In fact, very similar to the NASDAQ, which first went down very sharply in early 22. But you know, the NASDAQ has a berserk rally year to date. And as a result of that, the NASDAQ is 0.1% CAGR over 2 years compared to India's minus 0.2% Nifty 50 over a 2-year period. So really speaking, no great difference. Now, the two worst performing markets, obviously anything to do with China. So China and Hong Kong at the bottom of this pack on a 2-year basis. Many of the European countries as well not doing so well on a 2-year basis, partly because of, remember, they also got the impact of the Russia-Ukraine conflict hurting them. But if you actually look at the top, outside the India mid-cap, small cap, you've actually got markets like Brazil, which has done well. We don't have markets like, Mexico and some of the other smaller markets, but many of them have also done well. So really in a global context, India has held up well in terms of being flat over a 2-year period when many other countries have faced differences. But for a US denominated investor who also has the opportunity to invest in the US, actually there's been no difference in returns between India large caps, US large caps, and US technology. Few EMs have done better than India. It's India mid cap and small cap which have done amazingly well, helped in large part by the flows that have gone into these companies. They're also being seen as being sort of insulated from some of the global growth worries. We'll have to see how that plays out. But interestingly, this is not the behavior of small caps elsewhere in the world. You can look at the behavior of US small caps. It's right there at the bottom, minus 10% CAGR over 2-year period. And that's primarily because of concerns that the sharp hike in rates will hurt the small cap companies more. Now in India as well, of course, there's been an increase in rates, but as you saw in the previous slide, nothing as dramatic as what has happened in the US, and therefore to that extent, perhaps mid and small caps have not done as poorly in the Indian context. But just important to remember that this outperformance of mid and small cap is quite remarkable, and of course, we'll talk about the valuations later. So moving on quickly to the next slide. Now, all of you are aware that the period 20 to 22 was an incredible period for earnings of large cap Indian companies. Between March 20 and March 22, overall GDP of India was more or less unchanged. And when you look at this, you can see over here the sort of purple line, which is the Nifty. It's up marginally by about 10-12% over the entire period. Starting point 17,500, finishes at 19,638. But because of the sharp increase in earnings, you actually have a Nifty which has derated from a starting trailing PE multiple of 26.6 to a trailing multiple of 21.4. So, this is the way in which markets sometimes work through very extreme valuations. We had talked about rich large cap valuations 2 years ago when the markets were at almost 26 times earnings on a trailing basis. And over 2 years with markets sort of going up as on date, somewhere about 10% over the entire 2-year period, the the CAGR returns are down, and the valuations have started to work their way out of the excessive territory, which you will see on later slides. So, this is the kind of behavior investors have to worry about, that if everything about the future is already priced into the market and it is rich, it actually tends to eat into your future returns. So going ahead, we'll now jump to some of the economic trends. Not much to add over here. All I'll point to is actually that inflation number. RBI is forecast for inflation for the full year. I mean, this is the Bloomberg forecast, 5.4% for FY24. Remember, we just got the data for September CPI, which came in at 5%, which was much better than what people had anticipated. So after 2 months, outside the MPC comfort zone of 4 plus or minus 2%, CPI has come back inside, in a way justifying the RBI decision to stay on pause mode, looking through the increase in CPI brought about by the big increase in food prices. Current account last year was a record 2.7%. Given that fuel prices have moved back up, the current account deficit still looking to run in about the 1.5% territory. But the good news is that this is well within the comfort zone of the RBI of 2%. And so, even though fuel prices are now closer to $90 a barrel, we don't see this as disrupting the current account balance situation for India. So if you just move on from that to the I won't run through this. This is just sort of a high frequency slide, but the whole deck will be available to you and you can take a detailed look at it later. But let's just jump on now to look at the typical sections about market performance. I think the biggest standout is what you see here, which is the 1 year performance on the extreme right side. Nifty small cap, mid cap, 30% plus returns. Nifty 100, Nifty 50 far more muted at 12 and 14% respectively on a 1 year basis. And you've already seen the 2 year numbers in US dollar basis. Small caps and mid caps about 8 to 9% CAGR over a 2 year basis, when the Nifty 50 has been flat on a 2 year basis. So that's sort of the big story of what has been driving the market in recent times. Jumping forward, this is the trend of Nifty EPS over time and the current forecast for 24 and 25. If you look carefully over there, particularly I would highlight the bars for March 20 and March 22. Look at that remarkable jump in Nifty EPS from 489 to 775 in a 2 year period, when actually GDP in real terms was more or less unchanged. So that's the phenomenal jump in corporate profits that, literally I would say none of us saw coming. But that jump in profitability, is really what has given this market legs in terms of its post-pandemic performance. And now, of course, we are working through some of those excessive valuations that we talked about. FY23 was 8% growth. Current year expectations are about 18% growth. This is the Bloomberg consensus number. I still think it's a little bit of a challenging ask because underlying economic trajectory is not as strong. This is being supported quite significantly by margin normalization. But, there's always a higher degree of risk to my mind when it's margin normalization which is driving earnings growth rather than revenue. But that's just my, opinion. Moving on, these are just the forward forecast for FY EPS at every point of time. The typical year looks like the set of bars you see on the extreme left side, which is to say you start the year with a very high forecast, 884 in June 22. And by the time you get to March 23, you have a 50 rupee cut in the forward EPS estimate to 835. What's unusual about FY24, and that's good news really for the bulls, is that the forecast has more or less stayed unchanged over the last 4 quarters, 981 to 987, unlike the typical downward drift that we see. As I said, it's still a high bar, but so far good news for the bulls. The earnings estimates have not really dropped. So we'll move on now to look at valuations. This is the Nifty trailing PE and forward PE. I already showed you a zoomed in insight of the trailing PE earlier to show you how over a 2-year basis, the Nifty, delivering just about a low single digit CAGR and essentially allowing the PE ratio to start to normalize. You can also see this on the next slide, which has the price to book ratio and the ROE. Now, on the right hand side, the ROE is telling you that we are at the highest ROE in almost about 10 to 12 years, which is good news. Perhaps that underpins some of the valuation that we are seeing in the price to book, because the two are certainly correlated. And the yellow line is the long-term average of the price to book. The red line is one standard deviation above, which is where we would start to call the market rich. Today, we are somewhere between yellow and red, which tells you that we are somewhere in the fair value zone. So on the Nifty large cap, I would say we are reasonably in the fair value zone. And that's one of the themes that we'll talk about in our final slide. So the Nifty 50 in much better shape and fair value. This is where on the next slide, we have a bigger problem in terms of valuations. Mid cap and small cap valuations are in that red zone. The yellow line is the long-term average. The red line is one standard deviation above. And these valuations are currently sitting above that red line. My concern is much like what the Nifty did over a 2-year period. You could see a period in which as earnings come through and add to book value, these valuations start to normalize. So growth comes through, but because of where you are standing, which is to say you're already standing in rich territory and you have already discounted the earnings, you don't really see those earnings growth convert into actual capital appreciation. So that's, to my mind, the risk in the mid and small cap space. Moving on, this is a comparison of Nifty 50 vis-a-vis the 10-year GSEC yield. There's been a little bit of an upward move in the yield in the current month, and that's not picked up over here as yet. But safe to say, this is in territory which is more favorable for fixed income, but not as favorable as it was some time back. So, I'd say the message from this is quite consistent with the kind of portfolio allocation we are currently running in our balanced advantage fund, which is close to about 60% allocated to equities, halfway between the lowest that we could go to, which is 30%, and the highest that we could go to, which would be closer to 90%. So moving on to the next slide. Yeah, we've already talked about Nifty versus Nifty midcap, so I'll just jump this slide and go across to the next one. The most remarkable thing that we continue to discuss is the strength of the US economy. A year ago, rates were going up. We thought 2024, 2023 calendar, there was a risk of a recession in US. There is absolutely no sign of that. The data remains extremely robust. Unemployment is low. Inflation remains well above target. Today morning, I just saw on Bloomberg, the odds of one more rate hike in the US are now running at about 50%. What that tells you is that so far, the US has dodged a bullet. No sign of that recession. The economy is rock solid. It is in fact too hot for comfort as far as the US Federal Reserve is concerned. I don't think they have completely dodged a recession, because what we know from history is that there are sometimes a long lag time between rate hikes and it impacting the economy. Plus, we have to worry about financial shocks. So I don't think they have completely reduced the odds of the US economy running into trouble at some point of time. But certainly it has proved to be a lot more robust than the underlying belief that we had 1 year ago. In India, I already talked about this. The MPC kept the policy rates unchanged. And in a way, the inflation number that came yesterday should give them confidence. But at the same time, they did a little bit of a verbal intervention in the market by talking about bond sales through open market operations. They did cause the long end of the yield curve to move up slightly. So a little bit of a verbal volley, even while they kept the actual policy rate unchanged. Very quickly, if you think about the policy of the MPC and particularly the RBI governor, to my mind, one of the critical things that they are now articulating is that their target is 4%. It is not 4 plus or minus 2. I think in practical terms, what that means is that the bar for when they would be willing to cut rates has gone higher, because they need the rates to be demonstrating a 4% trajectory for them to think about cutting rates. Just rates coming back within 4 plus or minus 2 is not good enough for them to go out and cut rates. So I think that's the messaging that they are trying to give, and that's quite consistent with talking about a 4% target. Nifty 50 earnings consensus estimated to grow slightly above 18%, close to 19%, unchanged from the start of the year. We already talked about this. Significant dichotomy in valuations between the Nifty 50, which is in the comfort zone, not so much for the Nifty Mid Cap 150 and Small Cap 250, which are rich. So our advice, adopt a staggered approach towards equities. A bias towards large cap strategies is preferable. And finally, equity hybrid funds, such as balanced advantage, multi-asset, and equity savings funds that we run, we think are a good way to think about making lump sum investments, because you're getting exposure to equities based on where equity valuations are in the cycle. And if valuations were to go lower, we will automatically raise the exposure in those funds, because it is a model driven approach. So equity hybrid funds is something that we are recommending, the balanced advantage and multi-asset for lump sum investments. Otherwise, staggered approach with a large cap bias is what we prefer. So I'm going to halt over here my session or my conversation for today, and I'll hand over to Amit Premchandani, who will talk now about the value opportunity strategy that he manages. Over to you, Amit.
Thanks, Vetri, and good evening, everyone. Thank you for logging in. I manage the UTI Value Opportunity and the Dividend Yield Fund and the regular saving fund, which is kind of aligned to the UTI Value Opportunity Fund as far as the equity portion is concerned. Right now, I will focus more on the UTI Value Opportunity Fund, which, as you know, is an open-ended, value-oriented strategy. We have been consistently following the approach of intrinsic value instead of the multiple-driven approach of portfolio management as far as value is concerned. We have flexibility in terms of investing across the market cap based on the available opportunities. Margin of safety is one key parameter which we focus on while evaluating companies, especially on the value side of the barbell, which I will discuss in detail in the next slide. The primary lever which we use for managing this strategy is we use sectoral valuation filter for sectoral allocation. So that is one key lever that we have been using. As far as sectoral allocation is concerned, we focus on valuation in case of cyclical sectors. We use asset-based measures or book value-based measures to have a sense of where the valuation are in the sector as compared to history. Earning-based measures are largely used for taking into account valuation for stable sectors and non-cyclical sectors. Just to give an example how we approach this issue in practice, currently durable in a broad sense is a theme which is going through a significant pressure on account of sharp decline in volume growth, also margin headwinds which have been driven by hyper competition and commodity inflation. Some of the sectors or the products within the durable themes have been disproportionately impacted either by erratic weather patterns or specific management churn-related issues. In our view, we think that these are short-term headwinds. If we adjust for the normalized earnings, valuation are quite comfortable if we look at durable as a pack. And also the implied growth as reflected in the valuation is significantly below the other side of the consumer play, which is staple and discretionary. The same thought process was applied in IT as a sector. You can see the graph where we have been adding IT during the last 1 year down cycle, and we have been reducing IT when the implied growth was in mid-teens. Our sectoral valuation approach can be also compared to the current online sales which you are seeing in Amazon or Flipkart, where the same product is available at 25 to 50% discount for a 1 week duration. We use the similar approach where same high quality companies going through cyclical pressures or high quality sectors going through short term margin or volume pressures are available at a significant discount to their long term normalized earning based averages. The second lever which we use is the use of barbell approach. This lever is actually across the sectors. You can see that across sectors we have exposure to stocks which are at one end of the barbell in terms of cheapness, and also in the other end of the barbell. Barbell is kind of an exercise equipment which is weight attached to both ends, and similarly the concept is applied in the Value Opportunity Fund, where we invest in both set of companies. On one hand, we invest in companies which are going through cyclical downturns but have no terminal or no or very low terminal value risk. And market is focused excessively on the current pressure or current cyclical pressure of the business. And on the other end of the barbell, we also invest in high growth oriented companies which are very strong franchise, long runway for growth, but they are not mispriced in terms of very high implied growth. So we try to invest in companies when they are cheap relative to the expectation. And we try to avoid taking any balance sheet risk or any terminal value risk when investing in especially cyclical companies. We are quite comfortable in taking a P&L related risk. To give an analogy in terms of barbell, largely we are focused on buying companies or buying. So when you go and go out to buy clothes, just imagine you are comfortable buying from both Pantaloon as well as Shopper Stop. While in value of opportunity framework, we are trying to avoid buying clothes from V-Mart as well as the Palladium Mall, which is one of the high-end mall in Mumbai. Just from a visual point of view, imagine that we are at both side of the barbell as far as the stock picking is concerned, but we have eliminated some of the outliers. In terms of how we use intrinsic value as an approach, since we do not follow a traditional multiple driven approach, we kind of build guardrails around the portfolio construction. We have few guiding principles to ensure that we have a stable we have stability in terms of outcome and also consistency in terms of approach. For example, we have been consistently following or arguing for companies may have higher valuation because they have higher ROIC or higher return on capital employed. Hence, we have been investing in healthcare as a sector, although it doesn't qualify in cheap as a traditional measure of valuation. If you look at traditional measure of valuation. Similarly, we are very comfortable investing in sectors which have high operating leverage if we have got the cycle right. For example, we had invested in a hotel stock, provided we are at the right side of the cycle, because hotel is a very operating leverage heavy business. We also focus on trying to capture option values which are embedded in the companies, and we have been investing in many. We had invested in many companies which have option value attached to it. Recently, we had again taken exposure in InfoEdge, which have a lot of option values attached to it in the form of investment it has done. And we, as a valuation metrics, we have been focusing more on free cash flow yield as a predominant metrics to look at, especially when we look at growth-oriented stock. Some of the avoid areas we have is generally we do not invest in companies where there is a balance sheet risk. So we have actually exited many companies where we may have invested, considering that they are going through cyclical pains. But whenever there was a balance sheet issue, we kind of exited even during cyclical downside period. If there is any balance sheet related issues, we kind of avoid these companies. Also, we avoid companies which have poor capital allocation. So we generally, hence, as a measure, generally avoid SOTP stories where a single company is investing in many different businesses, and we don't know where the cash flows are going. In terms of in terms of how barbell is approached in practice, we just move into the next slide. So here we have given some examples of how we use the barbell in practice. So you can see that in IT, we had invested both in Tech Mahindra as well as Infosys. Tech Mahindra was or is still going through a change in leadership, but the change in leadership is driving expectation that it will now align with industry leaders in terms of growth as well as margin. Historically, margins and growth profile have been volatile in this company. While on the other hand, in the same sector, IT, we have invested in Infosys, who has demonstrated growth, which has been better than most of the peers over the last 5 years. And even the large deal pipelines that we see have been best in class. Similarly, in the auto sector, on the growth side, we have invested in Aisha Motor. It is catering to the premium segment, hence benefits from the natural tailwind of premiumization, which we are seeing. It has also expanded the product basket through recent launches. While on the other hand, we had also invested in Bajaj Auto, which have multiple levers with exposure to domestic two-wheelers, exports, three-wheelers. It is now expanding its addressable market by entering into EV in the scooter segment, tie up with Triumph and KTM on the premium bike segment, and it also has a very high dividend yield. Another sector where we have, just to give an example, pharma is another sector where we had invested both in 100% domestic oriented company, which is Eris, which was going through some pressure on margins because of some acquisitions that they have made. But 85-90% of the portfolio was focused on chronic and subchronic segment. So it was just going through some short-term margin pressure. On the other side of the barbell, we had invested in Cipla, which is a leader in the respiratory segment in India, focus on complex products largely in US, and also runs a very high margin EM business. It is going through some FDA inspection related issues, but we think that that is transitory in nature. In the BFSI or the banking segment, it's a very interesting example in the sense now both HDFC Bank and ICICI qualify on the growth side of the barbell. While when we had invested in ICICI Bank, it was largely it was at that time on the value side of the barbell, but now it has firmly placed itself into the growth side of the barbell. HDFC Bank, it is going through some short-term pressure because of short-term margin pressures because of the merger. But we think that retail franchises actually got an upgrade post the merger with HDFC because now they have almost 30% of the book in the mortgage, which is very high duration, stable book. We are not really concerned about the long-term ROA profile or trajectory of HDFC Bank. ICICI Bank has been delivering significantly better than actually expectations over the last 2-3 years. And now it has the ROA, which is the best in class, qualifying it on the growth side of the barbell. While on the value side of the barbell, we have Axis and IndusInd Bank. Both are decent franchises, trading at relatively muted multiples. There has been increase in OPEX in Axis Bank, which have been significantly higher than expectation, but we are kind of continuing to hold that. IndusInd Bank has been going through a lagged improvement in asset quality, and also it's a work in progress as far as the liability side is concerned. So these are some of the sectors where we have invested across the both end of the barbell, and we just wanted to highlight how our barbell strategy operates in practice. So this is the third lever that we use, which is the flexibility to invest across market cap. This is used in a more measured manner. Our range of allocation has moved from 18 to 35% over the last 5 years. We had increased in the range of allocation to small and mid cap. We had increased allocation to small cap in quarter 1 of financial year 24, actually taking the small and mid cap exposure to almost 35%. However, as Vetri already had explained, there has been a sharp spike in multiples over the last, especially 3 months. So we have marginally started reducing the small and mid cap exposure. Current exposure stands somewhere around 33%. This is broadly the sectoral allocation. The green movements show the increase in sector allocation, and the yellow movement show the decrease in sectoral allocation. Just to start off, pharma has been the largest overweight and continues to be a large overweight. Healthcare as a percentage of GDP, healthcare expenditure is still very low in India at around 3%. Within India, if the formulation segment growth of chronic has been higher than acute over the last 7-8 years, there have been 3 to 4% difference in CAGR between chronic and acute, and our exposure is largely into chronic heavy companies on the domestic pharma side. We continue to be positive because of the stable domestic growth. Now there is a lower pressure on US generic pricing because there have been a supply challenge in US, and margin profile of the pharma companies have started improving over the last 2 quarters. Right now, valuation are above average, but we are continuing to hold on to a large overweight position, largely because of that we see in the pharma space. Use our overweight after the sharp run up over the last 1 or 2 quarters. Here again, the revenue growth has picked up, especially on the back of increase in volumes, as well as what you see a premiumization-led growth. So average selling price of both two-wheelers and passenger vehicles have continued to go up because of the trend of premiumization. There have been a significant increase in SUV share in passenger vehicle and 125cc plus share in the two-wheeler segment, again reflecting the premiumization trend across the auto play. And margin uptick continues to play out. Even this quarter, we expect margins to continue to inch up. EV remains a risk, but it is more in two-wheelers and then followed by PV. We don't see EV as of now as a risk in commercial vehicle segment. Within the overall consumer segment, we only have overweight in the durable space largely, and we have been reducing over a 1-year period weights in stable and discretionary. Valuation continues to be expensive in the staple segment, especially given the fact that last 5-year volume growth have been muted and implied growth have not taken into account that sharp decline in the volume growth. Durable, as I explained, is a segment where we have seen a sharp erosion in margin due to competition, and valuation have also corrected significantly based on normalized earnings. So we are significantly overweight durable now. We have been reducing our active weight in BFSI after the sharp run up with some of the large active weight that we have. The funded active weight in a few large well-capitalized banks. It continues to be the same. We are just moving the weights from some banks to other banks. We think that what the sector is going through is an exceptional period of exceptional tailwinds in terms of asset quality, as well as the ROA and margin profile. Loan growth has inched up, which is positive. It is now in mid-teens, driven by retail. But we are now also seeing first kind of worry coming up in terms of unsecured loan, because the last 2 years growth have been abnormal, and we may start to see some surprises on underwriting if the job environment continues to deteriorate, especially in the IT sector. The margin expansion which we have seen in the sector last year will start reversing in FY24 as the liability cost will catch up. The good part is that valuation are very comfortable in that sector. So we are not moving underweight. We have just reduced our overweight by a few percentage points. Finally, IT is a sector where we have moved from underweight to overweight. And again, this is driven by the fact that we have seen the Indian IT companies have demonstrated their ability to gain during periods of disruption. So we even now, if AI is a disruptive force, we think that Indian IT companies will be able to to take out a market share even in this disruption. The market share of Indian ITs have been on a long-term trajectory. There is a near-term headwind in terms of developed market slowdown because of the high interest rate, but we are using it as an opportunity to participate in a high ROIC generating sector, which also have a very good payout ratios, which is available now at decent, reasonable valuation. If you look at implied growth, they have gone down from 15% level on average in 2021 October, say, to now high single digits. So we are kind of comfortable with our exposure now in IT. This is just a reflection of where we are in terms of valuation. We are at around 20. We benchmark ourselves with price to book as a valuation matrix, because it is a much more stable matrix to use, and we are at around 25% cheaper than our benchmark, which is the Nifty 500. There is just a portfolio turnover ratio. We can kind of continue to evaluate what we can do to improve performance. We typically have a barbell strategy, which I explained. And on the growth side of the barbell, our churn ratio is typically much lower. We do more of position sizing rather than complete exit unless there are some specific issues which come out. While on the cyclical side or value side of the barbell, there is a relatively higher churn because we enter and exit stock based on the cycle we are comfortable in. So most likely we will continue to evaluate it, and as you can see that over the last 1 year, maybe it has gone up churn ratio, and again it has gone down recently. But we think that we need to kind of slightly increase this churn ratio to somewhere between 30 to 40%, and we will work on that direction. But we will not churn aggressively just for the sake of churning. We will focus on churning more on the cyclical side of the portfolio rather than on the growth side of the portfolio. This is another interesting slide where we want to present that since we have a barbell strategy where we invest in both growth-oriented stock as well as on the cyclical stocks, our portfolio quality is generally better, and it is reflected during market downturns. So standard deviation of the portfolio is low, as you can see. If you look at the standard deviation of the portfolio as compared to benchmark, generally we are significantly lower than the benchmark. If you just see, we have been lower than the benchmark anywhere between 1 to 0% negative as compared to the benchmark. So we have a lower standard deviation. And on an overall absolute level also, you can see that blue line where we have seen that the standard deviation of the portfolio has been on a declining trajectory, again reflecting relatively better quality portfolio. Even during past performance, we have seen that during market sell-off and during sharp drawdowns, we have more downside protection as compared to our peers. And this is mainly because of the fact that our exposure to high ROC or better ROC profile companies is much more, and as we believe, in terms of managing the portfolio on an intrinsic value basis rather than a multiple-driven approach. Finally, this is broadly our top holdings. As you can see, across the sectors, we have invested in both sides of the barbell, whether it is bank, healthcare, auto, and now you can see some of the consumer durable names also coming up at the top in terms of the top 20 stocks. So this is broadly what I wanted to talk about the Value Opportunity Fund. Just a last thought that we generally have a very high active weight at 65%, which has been the active weight broadly on an average over the last, say, 5 years. And we have the current active weight also anywhere between 64 and 65. And we continue to tend, and we try to maintain a very high active weight and try to avoid having any position in the portfolio which is underweight. I will just stop at that and just Niranjan, over to you. Thanks.
Yeah, sure. Thanks a lot, Amit, for that detailed rundown on UTI Value Opportunities Fund. So now we will move on to take questions from our viewers. So while we have received few questions from our participants, I request our participants to continue to post your questions. So we will take as many as possible over the next 15 minutes. So, Amit, here is the first question. So, you mentioned that the current allocation into mid and small cap is about 33% of the portfolio. So, what is your view on this particular segment, given that we are seeing that the valuation is slightly elevated in this case?
If I would explain the mid and small cap allocation in terms of almost 6% of mid and small cap is sitting in healthcare as a sector. And another 6%, roughly 6% of allocation is sitting in durable as a sector, because durable, we don't have any large cap, only one large cap, and we don't have that large cap. So durable is largely a mid cap and small cap oriented sector. So almost 12% of the portfolio is in these sectors. And as Vetri showed, sectors which have done really well, especially also in mid cap and small cap, have been PSU banks, infrastructure, and we hardly have any exposure to these set of mid and small cap ideas. But given that overall valuations are really uncomfortable in the mid cap and small cap, so we are starting to trim exposure across sectors in mid and small cap, except the durable part, because we are just building position in durable, and we think that durable as a sector is going through actually a cyclical downturn. Other than that, if we are finding any interesting ideas in mid cap and small cap which satisfy our valuation framework of intrinsic value, we are open to investing. But if you have to take a call between the third lever of increasing allocation to large cap or mid and small cap, actually we are in the process of reducing mid and small cap allocation as far as that lever is concerned.
Sure. Thanks, Amit. Vetri, there is a question for you. This is a question coming from Mr. Jayant Keshav Rao. So the question is, the geopolitical unrest has once again resurfaced, impacting the market's sentiments globally, right? So, however, are there any specific implication of increased tensions in the Middle East impacting Indian markets?
So 2-3 points over there, Niranjan. I think one is we'll just have to deal with the fact that this is a world in which there's going to be more geopolitical tension. I think that's just a fact of life, partly to do with the fact that the US, as the policeman of the world, has chosen to go into retreat for their own set of reasons. So you just have to live with that. Having said that, there's no easy answer to the question you're saying. If the situation spirals out of control, goes beyond just a limited engagement between Israel and the Hamas in the Gaza to a more widespread level of conflict and war between the different countries in the Middle East, then of course we really don't know the path down which we are going. But I think the more mature heads in the room, including the US, where Secretary Blinken went to Israel yesterday and very categorically said that there is a way in which economies, rather countries, which are democracies, which follow the rules of war, how they will engage even when they have to protect their own security interests. And even Saudi Arabia doing its own bit to try and ensure that the conflict doesn't spiral out of control. So there's reason to believe that some cool heads are trying to get involved and make sure the situation doesn't conflagrate. But there's a very popular phrase in the context of conflict, which is the fog of war. And in the fog of war, people can end up doing irrational things. So I think we'll just have to wait and watch. But certainly, the cool heads are trying to ensure that the fog of war does not become a challenge. I think as far as oil prices are concerned, because I've heard some concerns and I saw some chatter about oil prices are concerned. Remember, Saudi Arabia has been cutting output to ensure that oil prices move higher. I think they would also understand that beyond a point, if this conflict were to cause oil prices to go up, it is not in their interest, because that would eventually guarantee a negative outcome for global growth and therefore eventually for global demand for oil. So to the extent that they cut production to cause prices to go up, potentially, they may actually reverse their position if prices were to spike higher, because what they want is sustainably reasonably high prices. They don't want a spike which would actually cause the global economy to keel over. They don't want a spike that would actually cause everybody to redouble their efforts into investment in renewables. So I think they will play a balancing act, but that's my guess.
Sure, Vetri. Thanks. In fact, there was a follow-up question on oil. So, if you can slightly elaborate on that part. So, do you see any major change in the consumption pattern of oil importing countries? And also, could there be an impact on inflation in some of the major economies as well? So, if you can throw some light on that.
Well, in large part, that's already covered in what I said earlier. But obviously, higher oil prices, which will filter into the inflation numbers. But remember, even in an Indian context, I remember the exact number offhand, but the actual impact of a $10 increase per barrel into CPI is quite limited, because CPI does not directly pick up fuel prices. It picks up the change in the cost of transport. And remember, in any case, the Indian government very often is sort of playing at this double role, that when fuel prices go down, they don't pass on the benefit. And then when fuel prices go up, they don't, hike prices either. So they've sort of played a balancing role in fuel prices. So I think as far as Indian inflation is concerned, it doesn't have a pass through to the same effect. Rebalancing of fuel supply and demand, I think the big story was what happened after the Russia-Ukraine conflict last year, whereby Russian oil and gas, which used to flow towards Europe, has actually shifted its trajectory towards Asia. But outside of that, I don't see this conflict immediately leading to any rebalancing of global supply demand.
Sure, Vetri, thanks. That helps. Amit, going back to the discussion on UTI Value Opportunities Fund. So, what is the risk control framework that we have adopted in this particular fund in terms of avoiding the value traps? So, in fact, you did elaborate when mentions in your deliberation a bit, but if you can elaborate on that, that will help.
So, thanks, Niranjan. In terms of value traps, we avoid investing primarily in stocks which have terminal value risk. So, we consider terminal value risk as one of the value traps, where companies show very high free cash flow yield, very cheap valuation in terms of PE, and are appearing very lucrative. But they are there for a reason, which is that market is not confident, or nobody is confident that this business will survive over the next 5 to 7 years. So this is the primary guardrail which we use to avoid value trap. We avoid investing in companies which have on a long-term basis not generated ROC, which is higher than the cost of capital. So there's another way of another guardrail which we use to avoid value trap. Obviously, every year the companies will not generate ROC higher than the cost of capital, but during good times they should generate higher ROC as compared to cost of capital. Just to again point out, we have been we were avoiding investing in some of the thermal stocks because we thought thermal power is a terminal risk. But we have slightly diluted our view in that because the way we are seeing things evolving, the power demand supply dynamics in India, it appears that over the last next say 7-8 years, we will continue to use coal as the primary fuel for power generation. Although the growth in terms of thermal power will be pretty muted, but still 60 to 70% of our requirement will be largely met through thermal. Hence, we have invested in a proxy to the thermal power, which is Coal India, because it generates 35% ROE, 30 to 35% ROE, and it has a very high cash balance. And we think it's a cheaper play to play the increase in the demand of power, because most of the increase in demand and power is going to be met by increase in thermal power, which we have seen in the last 3 to 6 months.
Sure, Amit, thanks. There is a question on banking sector. So this is a question again to you. So there has been a relative underperformance in the private banks as compared to their peers in the recent period. So what explains the return divergence, and is the powder dry enough for the banks, private banks, to sustain the margin pressures going forward? So if you can throw some light there.
So we have seen a cyclical turnaround in terms of growth as well as return ratios in the non-private banks. They have come out of a very painful 10-year down cycle. Or the down cycle started in 2013-14, and they have come out of it in 2022-23. The entire sector has come out, but PSU banks were disproportionately impacted, and they have come out of this cycle now. And it's a cyclical opportunity for them. On a long-term basis, we think the market share dynamics of shift of market share in favor of private banks will continue. Capital profile of private banks is significantly better than the non-private banks. The long-term ROA profile of private bank is significantly better than non-private banks. There are exceptions to that. There are large PSU banks which are doing as well as private banks, but broadly on a sectoral basis. And the OPEX, or the amount of cost required to compete in a digital environment, requires a very large balance sheet, requires very huge sums of profits which can be deployed for the next generation technology. And we think that there are only select few companies or banks which are employing or investing in technology in a reasonable manner. And we think private bank again score much above the peers in that. So we are positive on private banks. We are positive also on a very large public sector bank. And we are looking at it from a stock specific point of view. There have been a merger which has driven significant underperformance of a specific private bank. But we think that that is cyclical, and on a long-term basis, the ROA trajectory of the private bank remains largely unchanged. On the margin question, we think that most of the banks benefited, especially private banks benefited by the repo rate hike, because a large part of their loans were repo rate linked, because large part of their loan is retail. And we were never comfortable, or we never believed that such margin can sustain. And we think, and market also never believed that that margin can sustain. So there will be cyclical downturn in margin, especially in private banks, some of the private banks which are mortgage heavy. But market is also already discounted that because it's not that the market believes that these margins are sustainable. In the PSU bank, that decline will come with a lag, because large part of the book still with PSU bank is in MCLR linked.
Sure. Thanks, Amit. There is a question on IT. So if I can request Vetri to answer this. So Vetri, the IT sector is likely to witness a muted demand growth due to continued macro uncertainty, and also limited near to medium term upside potential. So however, do you see any change in the narratives in any specific pockets, and what are the possible catalysts of growth in the long term? So if you can answer.
So very quickly, if you look at the IT sector, I think it's been my view for a long time now. This is one of the few sectors in which you find multiple companies from India creating a sector in which we are globally competitive, right? So I think that's the strongest reason to look at this. The second reason to look at this is that these are very disciplined companies in terms of converting profits into cash flow, and wherever they don't need that cash flow for their own growth, they actually return a significant part of that cash flow to their shareholders. So it sort of underpins their total shareholder return that they generate for us. So from my point of view, this is an area where we would like to be invested. It's only a question of, are the valuations right? Now, currently at this point of time, the news flow is quite adverse. The companies are cutting back, their visibility is low. So the way I would define it is that the more the news gets adverse, and if the stocks were to sell off into that adverse news and valuations get cheaper, we would actually look at it as an opportunity to accumulate these businesses, presuming that the embedded growth expectations in those stock prices are something that we are comfortable with. And as I said, because they are globally competitive, we would give them the benefit of doubt in terms of their medium-term growth prospects. But use the adverse news, use any reduction in valuations to increase exposure is the way I would define it. This window is slightly broad, and I think I spoke about this maybe 2 or 3 months back as well, that the window of opportunity to accumulate IT may be slightly broad because visibility is weak. So use downdrafts and valuations to accumulate is really what would be my message.
Yeah, thanks, Vetri. So, in the interest of time, I think we will take last two questions. So, one question to you, Amit. Which are the sectors of opportunity you think the fund is actually bullish on from today's point of view, from a structural recovery point of view, especially if you can throw some light there.
So, as I discussed, durable is one sector where we are seeing cyclical downturn over the last 18 months. Some of the cyclical downturn is because of new players entering, creating hyper competition and margin pressure. The commodity related downturn was margin pressure was also there, but it kind of will have already played through over the last 2 quarters, and it will kind of be an upside now given that commodity prices have corrected as compared to the last year's pace. Volume growth has been disappointing for the sector per se. In some cases, it is because of erratic weather patterns. And we think that all these are cyclical elements. The core profitability, ROC or brand profile of many durable companies remain intact. It's a very wide sector, so we cannot have a sectoral valuation of durable because you will have a luggage company in durable, you will have a fan company in durable, you have a AC company or a two-wheeler or a washing machine company selling washing machine also in a durable. So it's a very wide sector, and the margin profile and the earning profile of the sector is at cyclical lows. We are very comfortable investing in that sector as of now. Another sector where we have been bullish and investing from a valuation point of view is metals. The balance sheet profile of the companies in the metal sectors have improved sharply over the last 4 or 5 years. We are going through a down cycle in terms of global growth, global commodity demand. Yet the margin profile of these companies are significantly higher than the previous down cycles. Actually, the margin profile of some of the metal companies is higher than the previous highs, previous cycle highs in a down cycle. So, and valuation are not expensive. They generate significant free cash flow now, and they don't have any leverage issues. So these are two sectors where we are very comfortable right now in terms of investing. We have overweight exposure both in pharma as well as even IT now, and we are comfortable with these exposures as well.
Sure, Amit, thanks a lot for that. And yeah, one last question to you, Vetri. So looking at the potential risk to monitor in the near term, such as the trade deficit or growth slowdown, shocks, or it could be narrowing bond yields, or in perhaps the potential surprises in the upcoming elections, right? So what could be the investors' approach today towards equities from long-term point of view, and also what is that you would expect investors to refrain from doing at this point in time? So, over to you.
Yeah, sure. So I would say, Niranjan, there are always risks in the market. If you can't see them, you should worry more because it means you're being blinded by the potential upside risk and the potential upside returns. But there is always risk. Some elements of those risks are known. Some elements of those risks are unknown. You mentioned many of the known risks. I would say there are also always unknown risks, right? And that is why the three most important words in equities are margin of safety. You need margin of safety, and that is what ensures that when a future which always has uncertain things, particularly the things which can be nasty, it helps you get through them because you did not overpay in terms of your expectations of future growth. So, I think that's the only way to navigate for margin of safety. Where are we in the current valuation cycle? I mentioned this earlier, Niranjan. We run a valuation model which feeds into our balanced advantage fund and our multi-asset allocation fund. Of course, that's guided more by large cap valuations, but based on valuations, the balanced advantage fund, for example, can go between 30% equity and 90% equity. If valuations are very cheap, 90%. If valuations are extremely expensive, 30%. Where is it today? It's stuck exactly halfway at 60%, which tells you slightly expensive, but nothing to panic about either. So that is what we would say. If you're looking to invest lump sum, look at some of these hybrid options like the balanced advantage or the multi-asset. The lump sum would go in, but because of the asset allocation model, not the entire money will go into equity. If the market were to correct in terms of valuations, either by a drop in prices or because markets go nowhere over a period of time and earnings keep rising and therefore valuations come down, automatically the allocation to equity would go up. So really what we would say is consider those sort of strategies for lump sum allocation. Among different sectors, we've talked about some of them. Amit talked about pharma, healthcare being attractive, banking, finance is more mid-cycle, and so is automobile sort of mid-cycle. I think IT increasingly, to my mind, is, as I said, buy it on dips. It's sort of getting into that territory where it's starting to get contrarian. So keep an eye on that. So that's sort of the lay of the land of something that we think about in terms of where to deploy capital today.
Sure, Vetri, thanks. Just a request to the participants here today. So kindly use the feedback link available on the screen to share your feedback on the topics that we covered today, but also webinar in general. So it will always help us to do better in our upcoming engagements with you. So with that, I will hand it over back to Vetri for his closing remarks. Thanks a lot.
Sure. Thank you once again, Niranjan, for doing a stellar job in terms of hosting it, taking the questions and putting together the presentation. Thank you, Amit, for your detailed take on the value opportunity strategy. And finally, thank you to all of you viewers who joined us. Of course, it will also be on YouTube. So if you want to share that link with people after some time, anybody wants to catch up on this conversation, it will be available over there. And the presentation is also available on our website and on our app. So you can sort of, download it and take a more detailed look at something if that so piques your interest. Thank you, and I look forward to connecting with you again next month in November. We are, of course, in the middle of the festival season now with one festival after the other. So in advance, best wishes to you and your family through this festival season, and we'll talk again in November. Have a great evening.
Thanks, everyone.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.